Something extraordinary is happening in the silver market right now, and most people have no idea it's coming. While everyone's been watching gold hit record after record, silver has been quietly setting up for what could be the most explosive move we've seen in decades. And I'm not talking about a modest 20 or 30% gain. I'm talking about the kind of move that changes portfolios, that creates generational wealth, that people talk about for years afterward. Let me show you exactly what's happening behind the scenes, because the signs are everywhere once you know where to look. The silver market is entering its fifth consecutive year of supply deficit. Think about that for a moment. 5 straight years where global demand has exceeded supply. That's not a temporary imbalance. That's a structural crisis that's been building pressure like a coiled spring, and that spring is about to release. Here's what makes this situation so unprecedented. Silver isn't just a precious metal anymore. It's become absolutely critical to the technologies that define our modern world. Every solar panel requires about 20 grams of silver. Every electric vehicle uses between 25 to 50 grams. 5G infrastructure, medical devices, water purification systems, they all depend on silver's unique properties. No other element conducts electricity and heat as efficiently. No other metal has silver's antibacterial properties. You literally cannot build the green energy future without it. And here's the problem. We're not mining enough of it. Global silver mine production has been essentially flat for years, hovering around 800 million ounces annually. Meanwhile, industrial demand alone has surged past 600 million ounces and keeps climbing. The solar industry is projected to consume over 200 million ounces annually within the next few years. Electric vehicle production is accelerating faster than anyone predicted. The gap between what we're pulling out of the ground and what industry needs is widening every single month. But it gets more interesting. About 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Silver miners don't just decide to produce more silver when prices rise. They're constrained by the economics of the primary metal they're actually mining. This means silver supply is remarkably inelastic. Even with prices surging, we can't just flip a switch and produce more. Now let's talk about what's happening on the demand side, because this is where things get really fascinating. Investment demand for physical silver has exploded. Silver ETF holdings have seen massive inflows, with institutional money pouring in at levels we haven't witnessed since the aftermath of the financial crisis. But here's what's different this time. Back then, it was primarily retail investors and smaller funds buying silver as an inflation hedge. Today, we're seeing pension funds, sovereign wealth funds, and major institutional players accumulating positions. Why? Because they're reading the same data we are. They see the supply deficit. They understand the industrial demand trajectory, and they're positioning ahead of what they believe is inevitable. The gold-to-silver ratio tells a compelling story here. Historically, this ratio has averaged around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. During periods of economic stress or precious metals bull markets, this ratio tends to compress dramatically. We've seen it drop to 30 to 1, even 15 to 1 during major silver rallies. Right now, even after silver's recent gains, the ratio suggests silver remains significantly undervalued relative to gold. Think about what that means. Gold has been making headlines, breaking records, getting mainstream attention. Silver has been moving, sure, but it hasn't had its moment yet. When that ratio starts compressing, when silver begins catching up to gold's performance, the percentage moves in silver are going to be substantially larger than what we see in gold. Let me paint you a picture of what happened the last time we saw a setup like this. It was early in the previous decade. Silver had been quietly building a base, consolidating, while gold was getting all the attention. The fundamentals were strong but not extraordinary. Then something shifted. Investment demand accelerated. Industrial users started getting nervous about supply. The price began moving, slowly at first, then with increasing momentum. Within months, silver had doubled. Then it doubled again. Investors who recognized the setup early and positioned themselves accordingly saw returns that dwarfed almost everything else in their portfolios. But here's what makes the current situation even more compelling than that previous rally. Back then, industrial demand was significant but not critical. Today, silver is absolutely essential to the energy transition that governments worldwide have committed trillions of dollars to achieving. The solar industry alone is projected to require more silver in the coming years than total annual mine production. That's not speculation. That's based on announced projects and government mandates already in place. China is installing solar capacity at a pace that's stunning even by their standards. Europe is accelerating renewable energy deployment in response to energy security concerns. The United States has committed massive subsidies to domestic solar manufacturing and installation. India is ramping up solar infrastructure to meet growing electricity demand. Every single one of these initiatives requires silver, and lots of it. Now, I want to take a brief moment here because this connects to something important for many of you watching. If you're sitting on retirement accounts, if you have a significant portion of your wealth in traditional paper assets, the dynamics we're discussing have implications beyond just silver prices. The same forces driving precious metals, the monetary uncertainty, the supply constraints, the industrial demand, these are reshaping how sophisticated investors think about portfolio protection. I've put together a comprehensive guide on how gold IRAs work, specifically for people with $100,000 or more in retirement accounts. It covers the mechanics of getting physical precious metals into your retirement account without triggering tax penalties, the custodian selection process, the storage requirements, all the details you need to make an informed decision. You'll find it in the description below. It's worth reviewing if this is relevant to your situation. All right, back to what's happening in the silver market, because there are some technical developments that are absolutely critical to understand. The COMEX silver market, where futures contracts trade, has been showing some fascinating patterns. Open interest has been climbing, while warehouse stocks have been declining. That's a setup that historically precedes significant price moves. When you have more paper claims on silver, while physical inventory is shrinking, something has to give. Either prices rise to bring more supply to market and reduce demand, or we see delivery issues that force a repricing of the entire market. There's been increasing discussion in trading circles about the disconnect between paper silver prices and physical silver premiums. When you go to buy actual silver coins or bars, you're paying premiums over the spot price that have been elevated for months. That premium is telling you something. It's telling you that physical silver is harder to source than the paper price suggests. It's telling you that people who want to hold actual metal are willing to pay up for it. This matters because at some point, that physical market reality has to be reflected in the futures price. The paper market can diverge from physical reality for a while, but not forever. When that convergence happens, it typically happens fast and violently. Let's talk about what the big players are doing, because their behavior is often more revealing than any chart or indicator. Central banks have been accumulating gold at record levels. That's well documented. But what's less discussed is how this relates to silver. When central banks buy gold, they're making a statement about their confidence in fiat currencies and their desire for hard assets. That same logic applies to silver, but silver isn't held by central banks in significant quantities. So where does that demand go? Into private hands, into institutional portfolios, into the physical market where supply is already tight. Major mining companies have been underinvesting in new silver projects for years. Why? Because at previous price levels, many deposits weren't economical to develop. The lead time to bring a new mine online is measured in years, often a decade or more. That means even if prices are attractive today, the supply response is years away. We're locked into this deficit for the foreseeable future. Some of the world's largest silver producers have actually seen production decline. Existing mines are depleting, ore grades are falling, the easy silver has already been mined. What remains requires more capital, more energy, more time to extract. This isn't a temporary situation. This is the new reality of silver mining. Meanwhile, industrial users are getting increasingly nervous. When you're a solar panel manufacturer and your production depends on securing silver supply, you start thinking differently about inventory. You start locking in supply agreements. You start building strategic reserves. That behavior removes silver from the available supply pool, tightening the market even further. There's a concept in commodities markets called backwardation. It's when near-term futures contracts trade at a premium to longer-dated contracts. It signals immediate supply tightness, a market that needs metal now and is willing to pay up for it. Silver has been showing periodic backwardation, a warning sign that the physical market is under stress. Now let's connect this to the broader economic picture, because silver doesn't trade in a vacuum. We're in an environment of persistent inflation concerns. Central banks have been trying to manage inflation while supporting economic growth, a delicate balancing act that historically hasn't ended well. When inflation runs hot, when currency purchasing power erodes, hard assets become increasingly attractive. Silver, with its dual nature as both industrial metal and monetary metal, benefits from both the inflation hedge demand and the industrial demand. Geopolitical tensions are running high. Trade relationships are being restructured. Supply chains are being reconsidered. Countries are prioritizing resource security. In this environment, physical commodities, especially ones critical to strategic industries, take on added importance. Silver fits squarely in that category. The dollar's role as global reserve currency is being questioned more openly than at any time in recent decades. Countries are exploring alternatives, diversifying reserves, reducing dollar dependence. When confidence in fiat currencies wavers, precious metals historically benefit. We're seeing that play out in gold. Silver tends to follow, often with more volatility and larger percentage moves. Let me tell you about something that happened in the market that perfectly illustrates the kind of move we might be setting up for. There was a period when silver was trading quietly, consolidating in a range, boring most observers. The fundamentals were building, but the price action was dull. Then one day, seemingly out of nowhere, silver gapped up at the open. Not a small gap. A massive gap that left traders scrambling. What happened? A major industrial user had tried to secure physical supply and discovered the market was far tighter than the paper price suggested. They had to pay up significantly to get the metal they needed. That reality check rippled through the market instantly. The price never looked back. Within weeks, silver had advanced 40%. Within months, it had more than doubled. The traders who were positioned ahead of that move, who understood the supply dynamics and recognized the setup, they made fortunes. The ones who waited for confirmation, who needed to see the move before believing it, they spent the entire rally chasing, buying at higher and higher prices, never quite catching up. Here's what makes the current situation so compelling. We have better fundamentals now than we did then. The supply deficit is larger. The industrial demand is more critical. The investment interest is broader. The geopolitical backdrop is more supportive. Every factor that drove that previous rally is present today, but amplified. Technical analysts are pointing to some interesting patterns on the charts. Silver has been building a massive base, a multi-year consolidation that's creating a foundation for the next major move. When you see these kinds of bases form, when you see a market coiling for an extended period, the subsequent moves tend to be proportional to the length of the consolidation. The longer the base, the bigger the potential breakout. We're seeing increasing correlation between silver and other industrial metals, particularly copper. Copper has been called Dr. Copper because of its ability to diagnose economic health. When copper is strong, it typically signals robust industrial demand. Copper has been making new highs. That's confirming the industrial demand story that underpins the silver thesis. But silver has something copper doesn't. Silver has the monetary metal component. It has the investment demand. It has the safe haven appeal. That dual nature means silver can benefit from both economic strength, which drives industrial demand, and economic uncertainty, which drives investment demand. It's positioned to win in multiple scenarios. Let's talk about what could trigger the next major leg higher, because understanding the catalysts helps you position appropriately. A supply disruption at a major mine would immediately tighten an already tight market. Mining operations face constant challenges, from labor issues to technical problems to political instability in producing regions. Any significant disruption would send shockwaves through the market. A major industrial user announcing difficulty securing supply would validate what the physical premiums have been suggesting. If a large solar manufacturer or electronics company publicly states they're struggling to get the silver they need, that would force a market repricing overnight. Continued strength in gold would eventually pull silver higher through the gold-silver ratio dynamic. As that ratio compresses, as silver plays catch-up to gold's performance, the percentage moves in silver would be substantially larger. A shift in investment flows, perhaps triggered by inflation data or currency concerns, could bring a wave of new money into silver ETFs and physical products. We've seen how quickly sentiment can shift in precious metals. When it does, The moves are typically swift and substantial. Regulatory changes around renewable energy or electric vehicles could accelerate the already strong industrial demand trajectory. Government mandates and subsidies have enormous power to reshape markets. Any policy that accelerates the energy transition accelerates silver demand. Here's something that doesn't get discussed enough. The silver market is relatively small compared to other commodities. Total annual silver production is worth maybe $25 billion at current prices. That's tiny compared to oil, copper, or gold. What that means is that relatively modest investment flows can have an outsized impact on price. When institutional money starts moving into silver, when pension funds and sovereign wealth funds allocate even a small percentage of their portfolios, the available supply gets absorbed quickly. We're already seeing signs of this. Silver ETF holdings have been climbing steadily. Mint sales of silver coins have been robust. Dealer inventories have been tight. These are all indicators of strong physical demand meeting constrained supply. The mining industry's response to higher prices has been muted. Yes, some projects that were marginal are now economic, but the big new discoveries, the major new mines that could meaningfully increase supply, those aren't materializing. Exploration budgets were cut during the previous downturn and haven't fully recovered. The pipeline of new projects is thin. What this means is that even if prices rise substantially, the supply response will be limited and delayed. The market will remain tight. The deficit will persist. Prices will need to stay elevated to ration demand and incentivize every possible ounce of production. Think about what that environment means for investors positioned ahead of this move. You're not trying to time a quick spike and get out. You're positioning for a sustained bull market driven by fundamental supply-demand imbalances that can't be quickly resolved. That's the kind of setup that creates the biggest returns. Let me share another historical parallel that's instructive here. There was a time when silver was considered primarily an industrial metal, important but not critical. Then the world changed. New technologies emerged that required silver's unique properties. Demand surged. Supply couldn't keep pace. Prices rose dramatically as the market adjusted to the new reality. Investors who recognized that shift early, who understood that silver had become critical rather than just useful, they positioned themselves accordingly and profited enormously. We're at a similar inflection point now. Silver is transitioning from important to absolutely critical. The technologies that will define the next decades, solar energy, electric vehicles, 5G networks, they cannot function without silver. There is no substitute that matches silver's performance characteristics at any price. That makes silver demand inelastic. When you must have something and there's no alternative, you pay whatever it costs. Industrial users understand this. That's why we're seeing longer-term supply contracts being negotiated. That's why companies are building strategic inventories. They're not waiting for prices to come down. They're securing supply while they still can, at whatever price is necessary. This behavior is removing silver from the spot market, from the available supply that sets the marginal price. As more silver gets locked into long-term contracts and strategic reserves, the spot market gets thinner. Thinner markets are more volatile. They're more prone to sharp moves when supply-demand dynamics shift even slightly. We're also seeing interesting developments in the recycling market. Silver recycling has traditionally provided a significant portion of annual supply. But recycling economics are challenging. It's expensive to recover silver from industrial applications. At previous price levels, much of that silver wasn't economic to recycle. Higher prices make more recycling economic, but there's a lag. The silver has to work through the product life cycle first. Solar panels last 25 years. Electronics get replaced on various cycles. That recycled supply isn't available immediately. What this means is that for the next several years, we're dependent on mine production and above-ground inventories to meet demand. Mine production is constrained. Inventories are declining. The math doesn't work. Something has to give, and that something is price. Now, I want to address something that often comes up when discussing silver. People ask, if the setup is so obvious, why hasn't the price already moved? It's a fair question, and the answer reveals something important about how markets work. Markets don't move on fundamentals alone. They move when fundamentals meet recognition, when enough participants understand and act on the information. The silver fundamentals have been building for years. The supply deficit isn't new. What's changing is recognition. More investors are paying attention. More analysts are highlighting the situation. More money is starting to position. There's also the reality of how commodity markets function. Futures markets can suppress prices through paper selling, through the creation of synthetic supply that doesn't exist physically. This can persist for extended periods, but eventually, physical reality asserts itself. When industrial users need actual metal and discover it's not available at the paper price, when investment demand for physical silver exceeds available supply, the paper market has to adjust to physical reality. We may be approaching that inflection point now. The signs are there in the elevated premiums, in the tight dealer inventories, in the declining warehouse stocks. The paper market is increasingly disconnected from physical reality. That disconnect can't persist indefinitely. Let's talk about what this means for different types of investors, because the opportunity looks different depending on your situation and objectives. For long-term investors focused on wealth preservation, silver offers a way to hold a hard asset that's in structural deficit with growing industrial demand. It's a store of value that also has utility value. That dual nature provides a margin of safety that pure monetary metals don't have. For growth-oriented investors, silver offers leverage to the themes reshaping our world: the energy transition, the electrification of transportation, the build-out of digital infrastructure. Every one of these megatrends requires silver. Positioning in silver is positioning in the physical foundation of these transformations. For tactical traders, silver offers the potential for significant near-term moves driven by technical breakouts, sentiment shifts, and supply-demand dynamics. The volatility that makes some investors nervous creates opportunity for those who understand the setup and can manage the position appropriately. The key is understanding where you fit, what your objectives are, and positioning accordingly. This isn't about speculation or gambling. It's about recognizing a fundamental imbalance in a critical market and positioning to benefit as that imbalance resolves. Here's something else to consider. Silver's affordability relative to gold makes it accessible to a broader range of investors. You can build a meaningful position in silver with capital that would only buy a small amount of gold. That accessibility means when sentiment shifts, when the investment community starts paying attention, the potential buying pressure is enormous. We've seen this dynamic play out before. Silver rallies tend to be more explosive than gold rallies because of this accessibility factor. When retail investors get excited about precious metals, they often gravitate to silver because they can accumulate more ounces. That buying pressure, combined with the smaller market size, creates the conditions for rapid price appreciation. The current setup has all the elements of those previous explosive rallies, but with stronger fundamentals. The supply deficit is real and growing. The industrial demand is critical and accelerating. The investment interest is building. The technical setup is constructive. The macro backdrop is supportive. What we're potentially looking at is a perfect storm of factors converging to drive silver substantially higher. Not in a straight line. Markets never move in straight lines. But the path of least resistance appears to be up, potentially significantly up over the coming months and years. And think about the implications if silver simply returns to its historical relationship with gold. If the gold-silver ratio compresses to levels we've seen in previous precious metals bull markets, we're talking about silver prices that are multiples of current levels. That's not wild speculation. That's just historical mean reversion. Now add in the industrial demand component that didn't exist to the same degree in previous cycles. Add in the supply constraints that are more severe than in the past. Add in the geopolitical and monetary factors that are driving safe haven demand. The potential upside becomes even more compelling. I'm not suggesting silver goes up in a straight line or that there won't be volatility along the way. Precious metals are volatile, silver especially so. There will be pullbacks, corrections, periods of consolidation. That's normal and healthy. What matters is the underlying trend, the fundamental drivers that are pushing prices higher over time. The investors who do well in these situations are the ones who understand the big picture, who can look past short-term noise and stay focused on the fundamental story. They're the ones who use pullbacks as opportunities to add to positions rather than reasons to panic. They're the ones who have conviction based on research and analysis rather than emotion. Here's what I'd encourage you to do. Look at the data yourself. Study the supply-demand fundamentals. Examine the industrial demand trends. Review the historical patterns. Form your own conclusions about where this market is headed. Don't take my word for it or anyone else's. Do the work and develop your own conviction. Because when you have that conviction, when you understand why you're positioned in silver, you can hold through the volatility. You can add on weakness. You can let the position work over time. That's how the biggest returns are generated, not by trading in and out, but by recognizing major trends early and staying with them. The silver market is setting up for something significant. The fundamentals are the strongest they've been in years. The technical setup is constructive. The macro backdrop is supportive. The catalysts for a major move are in place. Whether that move starts tomorrow or takes months to develop, the setup is there. For investors who recognize what's happening, who understand the supply-demand dynamics and the forces driving this market, this represents an opportunity to position ahead of what could be one of the most significant moves in the silver market in decades. The kind of move that people will look back on and wish they had recognized earlier. The kind of move that creates substantial wealth for those positioned correctly. The question isn't whether silver will move higher. The fundamentals make that almost inevitable. The question is whether you'll be positioned when it happens or whether you'll be watching from the sidelines, wishing you had acted when the setup was clear and the opportunity was in front of you.